Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Oana.
Okay, so we got this great chart that we pulled from the chief economist in ours blog. We're going to go through all the things in here, but basically we're going to talk about the last housing crash, which was the great financial crisis, 2008-ish area, right? And then today, we'll call it 2022, 2023. We are going to do some videos here with more like forward-looking stuff because we're getting close to 2023, and then potentially things are going to start happening.
Right.
Before we do that, though, if you're new to the channel, please subscribe, hit the notification bell, leave comments, and do all that stuff.
Yes.
All right. Okay. So we'll start with, we're going to start by putting up the chart. We're going to talk about all these individually. Okay. So what we're doing here is on the left side, you see it says key variables. Mm-hmm. And then it shows last housing cycle and the current housing cycle. We're going to go through all these because there's some pretty important things in here. Okay. So the first thing is it says job cuts. The last housing cycle lost 8 million jobs. It just, they're gone.
Right. So the thing to keep in mind with the job losses, we're not talking about layoffs versus new hires. We're talking about net job losses, right? So when you're looking at this time around and you see that it's nothing, it's because we are actually adding jobs on top of the ones that are being lost. So the net is actually not having a job loss, but having an increase in the number of jobs. Yeah,
and we're gonna get to a chart and show that. So the last housing cycle, the economy crashed too. Like it got really bad. 8 million jobs, and right now the last jobs report I think was for November, 362,000 jobs created, net jobs, more jobs than there were. So when you see the news and you see Twitter and Facebook and all these tech-related companies that are cutting jobs, what you don't realize is there are other industries that are doing well. Okay, so what we're going to do is we're going to jump to another chart here. This is a chart that we got from the NAR Economist blog. And as you can see that the jobs drops off precipitously around March, April of 2020 because of COVID. And a lot of people were just, hey, you're gone because we don't know what's going to go on. And then they built back up pretty quick. And as you can see, they've been continually going up. Okay, so that's the first most important thing. That's the total number of jobs.
Right.
Okay. All right. Now let's talk about why there is a net gain when companies are cutting. So Oana, what kind of companies are losing jobs?
So I think that there are a lot of companies losing jobs, particularly when you're talking about companies that maybe are technology driven and they've been growing year over year an absurd amount, and now their revenues are off and they're looking at really how many people does it really take to run the company and how many people does it really take to make the company move forward, right? So they're trimming some of the employees that maybe they shouldn't have been keeping. There's a school of thought that you should evaluate all employees every year and keep the good and get rid of everybody else and just keep hiring until you get to a point where you just have good employees, right? And that's a great school of thought. But that's kind of what's happening is a lot of companies are doing that. They are looking at who's productive, who's less productive, who has maybe a good attitude, who is maybe causing some strife, and they're making some business decisions about those positions, and that's partly where we're seeing a lot of the job cuts.
Okay, so we're cutting jobs, but then let's talk about travel, because the travel industry is booming, and those are jobs.
Right, they are jobs. They are certainly a different type of job.
Okay.
They are definitely not, certainly when we're talking about technology companies cutting jobs, and then we're saying, well, but travel's adding jobs. Well, those are not the same types of jobs. Those are not the same. Those are not the people that are losing their jobs from the tech companies are not being employed by the travel industry.
No, so, they're not going over there. No, they're not taking those jobs.
Right. So those are different sectors.
Those are jobs, though, to a lot extent, or the reason unemployment is 3.7%. It's so low because anyone who wants to work in some generic thing that doesn't maybe take, a computer science degree, right? They can just kind of go over there and work.
Right.
Okay.
So if you don't need specialized training, then yeah, there are lots of jobs, right?
Unless you're an airline pilot.
Specialized training.
Okay.
Okay. Specialized training, that's a different situation. And the jobs that are being cut, anecdotally, they tend to be middle management jobs. They tend to be, like I said, the employees that maybe shouldn't have been kept anyway.
Okay. Also, anecdotally, the software engineers that are being cut from these tech companies are all landing places. They're all finding jobs because what happened was some of the tech companies in Silicon Valley sucked up so much talent and was basically paying them money so they wouldn't go start other companies to compete with them. And then it made it harder for other companies to find engineers, but now those companies, they can find engineers because they're out there. And then the other thing too is if you still dispute that, even though we did add a substantial number of jobs just in November, that wage rates, total wages paid are up over 5.3% year over year.
Right. I think the interesting thing about this, not that I'm looking for a silver lining, but I think it is a real possibility, is as some of these people in Silicon Valley and other industries are being marginalized, let go, whatever you want to call it, some of them are finding opportunities to maybe build something new, build something better. So I think coming out of this, maybe a few years down the road, you're going to see kind of the fruits of this in new businesses, new industries, just advancements in all kinds of areas that maybe we wouldn't have had if these people would have kept their job working for their current employer. So I think there are opportunities. I think that people who are effective and intelligent and who have something to contribute will find a way to contribute.
Okay, we're going to put the chart back up again. The next thing we're going to talk about is very interesting, okay? Total payroll jobs. This is the total number of jobs, okay? And when we get down further, we're going to compare this to something else that's going to blow you away, and you're going to have the aha moment where you're going to be able to say, aha, now I know why housing did what it has done the last few years, okay? Total payroll jobs existing last housing cycle was 130 million in the U.S. Of course, we're a growing country. We now have 153 million payroll jobs. And then you have total jobs, which includes, that's based on a household survey. That's total jobs because you have people in this that are not necessarily W-2 salary employees, independent contractors, people like that, okay? Okay, so we'll move on down. Subprime loans. Last housing cycle, they were prevalent. Now, subprime loan does not mean 7 or 8%. It doesn't mean high interest rate loan, right? What is the difference, Oana, between a subprime loan and what we have now, which is basically like a paper loan?
So subprime loans tended to be loans provided to people who would not otherwise qualify for a loan, either because they had bad credit, no proof of income. They're basically loans that were, as we like to call them, that if you could fog up a mirror, that was helpful but not necessary.
Okay, what about the down payment requirements versus a regular loan?
Right.
For subprime loans.
Right. So some of those subprime loans had kind of bizarre down payment requirements. Some were even you actually could borrow more than the price of the house, and it was all kinds of crazy things going on. So remember, we had the 125% loans. So that means that if you bought the house for $100,000, you could borrow $125,000. So there were all kinds of things going on, and that kind of is lumped into that.
Yeah, you could literally buy a house for $400,000, get a $500,000 loan under the guise that you were going to fix it up, because all they wanted to do is loan you as much money as they could. Okay, that's gone. That doesn't exist. That was a huge factor that was removed during the last housing crash. Okay, here's the big one. This is the big one that's going to blow your mind, okay? And the numbers don't look impressive, but when we compare them to total jobs, you're going to have an aha moment. 5-year cumulative to new home construction before crash. So 5 years before the crash, we built 7.65 million homes, even though we only had 130 million people working, right? The last 5 years, we haven't even built 1 million homes a year, 4.9 million homes. So we're a much bigger country, and we've built much less new homes. So we have much less total homes, right?
Right.
Okay, that's the first thing. here's the amazing thing. Go back up and look at that total payroll jobs. We've added 23 million payroll jobs. We have not added 23 million. We haven't added anywhere close to that. And remember, we have to add a housing unit for every family unit, either an apartment unit or a house. We have to add these, and we're not doing them. We're way behind in adding these. So when you look at this and go, wait, if we've added 23 million jobs, we have not added 10 million housing units since the last crash.
Right.
Because most of that 4.9 million was the last 5 years. It took 8 years before that to do 5 million.
Right, and then keep in mind that the housing stock is aging, so certain houses have been taken out of circulation just because of their age. For whatever reason, they are no longer habitable and that sort of thing. So that really gives you a good picture of what's going on with housing, and that we are not in a situation where we have an excess inventory of housing.
Okay, I'm going to put the chart back up here. Inventory on market. Back then we had 3.8 to 4 million. Today we have somewhere between 1 and 1.2 million. To give you a better idea what this looks like, I'm going to put up the housing chart you've seen. This is the historical one. If you look at the very peak of it, what you'll see is that the very top, where that's like over 4 million houses on the market, that was the 2006 to 2008 timeframe. That was when that everyone was trying to sell their house because they were trying to get out of their bad mortgage, and at the same time the banks were foreclosing and then dumping all of those houses. So you had these houses that were literally on the market for 3 years because they couldn't sell, they got foreclosed, and it came back on the market. They put it on the market, then a short sale, then a bank-owned home, right? And Oana, you're the expert of bank-owned homes, having been a direct Fannie Mae, Freddie Mac. Literally, they gave you the properties to sell. Like you were the person they gave you the properties to, and you list them and sold them. When's the last time Fannie or Freddie called you and said they have an assignment for you?
Maybe they've lost my number.
Maybe we should call them and say we're still here.
No, but seriously, when you look in the MLS, we do have a field that says that designates whether that's a bank-owned home or not, and there are just very few.
There's an old commercial, the Maytag repairman. And he's just sitting there, and his phone won't ring because Maytag washing machines and everything or appliances are so reliable. The poor guy never gets to go out and fix anything. He's like the loneliest person in the world. So you're like the Maytag repairman for REO. Like, they're not going to call you because there's no REO, right?
If there is REO out there, please call me, because I'd love to do REO business again. I enjoy doing it.
Okay. All right. Put the chart back up here. Mortgage delinquency. These were the people that were... This was the precursor, meaning this was behind on the mortgage. This doesn't mean foreclosed. This just means behind. Okay. Last housing cycle, 10.1%, 3.6%, which is basically, if you look historically, it's 1 in 30 people are just behind. They missed a payment, they're behind. You miss one payment, you're behind. That's And I think there's a 15-day grace period. And they report it. So if you miss a payment and you get reported, the credit agency can see, and then that's how they pull these numbers.
Right.
Okay. The very bottom one there, homes in foreclosure. Okay. Now this is the foreclosure from noted. This does not have been foreclosed. This is in that pipeline of foreclosure. Okay. This is the leading indicator. Notice of default, notice of trustee sale. It's in that. Once it gets foreclosed, it's pulled out of this. It was 4.6% last housing cycle, which is a lot. That's 1 in 20 houses, okay? Current housing cycle, 0.6%. Which is very, very low historically.
It's basically negligible, yeah.
It's pretty negligible.
Well, especially when you consider that a good number of those will be redeemed and they will never be foreclosed.
Here is a chart I'm going to put up. This is another chart that we've used recently. This is the total number of homes in foreclosure. Historically, as you can see, if you go back to 2006, 7, 8, 9, it was a ton. And if you just keep going to today, it's basically none.
Right.
It's basically none.
Right. So remember, foreclosure happens for a lot of reasons. And in this type of environment where most of us have equity, it's probably happening because of some life event, usually somebody passing away or, some major catastrophic thing like that, because most people have equity and there's no reason why most houses could not be sold on the open market, except if there's something going on as far as title and not being able to sell the property because of that or something like that.
Okay. The last thing we're going to talk about is mortgage rates. Now, we do acknowledge mortgage rates have made it more difficult for people who are getting loans, especially people who are getting high loan-to-value loans, meaning the loan percentage is a big percentage of the loan. Right. 80% to FHA loans were like 96.5% of the thing, right? Because that monthly payment is more.
Right.
Okay. So what we're going to show you is this is the weekly mortgage rate chart. This goes from September 1st to December 1st. Okay. So it's 3 months data. You can see we peaked back in November, a little above 7%, and we're already back down. It looks like the trend is to go lower. There are some macroeconomic factors that are affecting this. And yes, the actual idea that the Fed would not raise rates again by 0.75%, that they said we may just do 0.5% or we may not even do that right now, has already caused the mortgage. Because remember, though that 7% mortgage rate was based on what the Fed said 6 months ago it was going to do to mortgage rates. And now that they're sort of backing off that, they're backing off. Because remember, they have to lead this. Because they're loaning this money months in advance. Because they lock the loan and then they're bound to it for the 30, 60, 90 days it takes for you to close on the house. So they have to add this risk premium to it, right? And then they also have to add the risk premium, all the other risk premiums to it. But it's this thing called interest rate risk. Okay. We're not going to talk about interest rate risk. It's a complex topic. But their interest rate risk is less now because, hey, we thought, we priced in that the Fed was going to do another 0.75 and then another 0.75. But now they're saying maybe they'll just do 0.5. And when they start to do that, they know historically that maybe the next one's just 0.25 and maybe they just leave the rates like that for a year and then they don't raise them again. So the mortgage rates and then the treasury markets are affected by that, and then interest rates. So Oana, we don't have the crystal ball. It's not here yet. We did order one on Amazon. When it gets shipped, we'll pull it out. We'll be able to look. I don't know why we didn't think of this a long time ago. We could have just 2008 or 9 gone. And we just seen Bitcoin. We'd been like, boom, Bitcoin, right? Okay. So what do you think about this? We don't know what rates are going to be next year. Fannie, Freddie, and NAR all said 5% in 2023. Some point they'll go back to 5%, and that may be a long-term couple-year thing where rates are 5%. We would personally love to see 5% because we would like to see stable. Real estate agents hate volatility.
The markets hate volatility. Everybody hates volatility. We all like things that we can plan on, that we can count on.
And one of the reasons we hate it is because it's the hardest thing we have to do is pricing a home appropriately for a given market. And it's harder to do because all the other stuff that we do, we're really good at. But then this volatility with pricing, it makes it a lot harder to do our jobs. And there's more risk if you screw this up, which we've seen, right? So how do you see this trend? I mean, we don't know. This could be noise, right?
It could be. And, there's certainly something to be said for that. This chart does go back 3 months. So there is some speculation that maybe that there's some accuracy to it, but we'll see. I don't think that we're going to see interest rates go much higher. Do I think that the Fed will raise interest rates again? Yes. Do I think that they're going to do it as dramatically as they've done it this year? No, not at all. I think that what they're looking to do is they're looking to find a way, an off-ramp from the raising of interest rates as a way of dealing with the economy. And I think that they're going to maybe do a 50 basis points, maybe one more 50, and then 25, and then maybe nothing.
Okay. The 7% plus rates are baked into at least two more 0.75 raises based on what the Fed projected. And if that doesn't happen, then we're going to continue to see this non-7%, maybe not even 6%, below 6%, which is probably completely reasonable. Because, obviously you just can't borrow money at an unlimited amount, especially in housing and things like that, because almost everybody has the ability to buy a house if you have income and if you have a credit score.
Right. And the other thing to keep in mind, lenders, they do have a business model, right? They do have a business to run. So one of the things that they're probably looking at is they are forward looking, and they're saying, hey, interest rates are going to be at this level. The sooner we get to that, as far as what we offer our clients, the better off we're going to be, because the less likely the client is going to be to want to refinance and pay back this loan. So we're going to keep these clients longer, because remember, it's in their interest to keep that loan as long as possible, particularly at these higher rates. So because there is a sweet spot, right, for all of us, where does it make sense to refinance? And if it's too close, it doesn't make sense for us to refinance, even though we're paying more interest than the going rate. So that's kind of one of the things that they look at forward looking as far as pricing loans, is they want to keep those loans for as long as possible at that higher interest rate.
Okay. Our contention has always been, and you can go back to our videos March and April of just this year, where we said this would not continue, that there would definitely be adjustment in home prices, that we thought the fall could be interesting to give us some very telltale signs about what could happen. These are definitely telltale signs. The fact that we have not seen inventory balloon, if that chart I put up that showed the inventory, this is the second lowest inventory, not counting last year this time, right, of homes. And inventory in Vegas has dropped 15% in the last month. We have 15% less homes on the market.
Right. And then, keep in mind that sellers are either, who haven't sold, but they still want to sell the house, they are either renewing or extending their current listing agreements. Okay. They are relisting with new agents, new brokerages. So they're still interested in selling. So the idea that everybody's pulling their house off the market because it didn't sell, that's a false premise, okay? Well, there are people who want to sell their homes, and they are still actively working on that.
Anecdotally, we have had people tell us they were thinking of selling, but they've decided to rent it out for longer. Right. They've literally contacted and is saying, I probably should have sold it last year, but I was going to sell it now, but now I think I'm just going to rent it out for another year or two. What do you think are going to happen in the rental market? Literally, that's the conversations we've had with people. And the biggest thing that wasn't on that chart that we showed were the number of people that own their house free and clear. So there's no risk. They don't have to sell.
Right.
It's 40%. 40% of the market is free and clear. And then of that other 60%, a huge percentage of that have so much money, equity in their home, that their price changes that don't force them to sell or make it so they have to sell.
Right.
Especially with 2.5–3% interest rates.
Yeah, and the people that we're chatting with that just want to know what's going on in the market, that's the same thing they're saying, is that they understand that whatever that automated valuation says that their home is worth, that's just for entertainment purposes. The only time that the value of your house matters is when you buy it and when you sell it. The in-between, it's just noise, just entertainment. And the appraisal you got in March, you can just throw it away. It doesn't mean, unless you're doing it for estate planning or some other, you're whatever. You just have some ulterior motive. Oh, I can show my house is worth this. That's great. But, we all know you could get an appraisal and then just put your house in the market the next day. And they don't even care. No one's going to use the appraisal. Right. Yeah. And then remember, you can have 3 appraisers in your house at the same time. They go back to their office and they each submit their appraisal report to you simultaneously, and I can guarantee you will probably have 3 different values. Oh, okay. This is a true story. This is off topic. We're going to talk about it since you're still watching the video. Okay. I hear all the time agents, after price negotiations up and down, where we come to a price, and then we get the appraisal, and the agent calls and says, we nailed the price because the appraiser came in with exactly the negotiated price. Oana, why is that? Well, we can say that the appraiser was lazy and just picked that price. Okay. We can say that, the appraiser looked at the comparables and said, that's close enough. I'll go with that. Okay. Or that the appraiser really judiciously looked at the comparables, made all the necessary adjustments, and confirmed that this is the ultimate price. But when it's all said and done, the appraiser looked at it and said, the seller was willing to accept it, the buyer was willing to pay for it, everything in the area is pretty close, done. If you, in a not house on the market, you just call an appraiser,
and you get a couple different, you'll get different values. You'll get different. They don't know. There's no government stamped value.
No, it's an art.
It's an art form. Anyway, final thoughts, because this was pretty, we talked about a lot of stuff that we've talked about in the past, but I liked the chart because it kind of lined up everything, and I just had to pull it off his site. I didn't have to create it or anything.
So, final thought, this is not a carbon copy of 2008.
It's nothing like 2008.
Nothing like 2008.
It's nothing like 2008. What about all the videos where people are saying it's worse than 2008? That have 30,000 views in 2 weeks.
Well, then they are getting really nice checks from YouTube, and we're very happy for them, and we wish them very happy holidays.
And they didn't sell their houses. They still own their houses.
And they still own their houses, so maybe they're going out with that money that they got from YouTube and buying some more houses.
Yeah, okay.
So those are my thoughts.
Okay.
So if you liked the video, if you thought it was interesting, amusing, entertaining, please like the video. Please subscribe, hit the notification bell. Please share the video. Please leave us comments and let us know what you think as far as comparing what's happening now versus 2008 or discussing anything else that you think is interesting. Please be nice to each other in the comments. And thank you.
Be nice to us in the comments.
Yes, be nice to have
the problem is the people who are not nice to us in the comments.
Yes.
They watched like the first 3 minutes and then they made a comment and they bailed.
Well, that's their purview. And
because we didn't say what they wanted to hear.
Good on them. That's fine.
All right.
So anyway, thank you for watching. Subscribe to the notification bell, like the video, leave us love notes, and we'll see you on the next video. Bye.
Bye.